Okay. Okay, for the second chapter, we are looking at the asset allocation decision. Okay, asset allocation decision. This is also important topic. Okay, so how you want to answer all these questions? What is asset allocation? Okay, what are the 4 steps in this in the portfolio management process? And what is the role of asset allocation in investment planning? Okay, why is policy statement important to the planning process? Okay, and then what objective and constraints should be detailed in a policy statement? And how and why do investment goals change over a person's lifetimes and circumstances? Okay, and why do asset allocation strategies differ across national boundaries? All right, financial plan preliminaries. Okay, first we look at insurance. So basically, life insurance, or maybe we call it takaful lah for the Islamic one. Okay, life insurance basically is term life insurance, provide death benefit only. Premium could change only renewal period. And then so universal and variable life insurance, which is provide cash value plus death benefit. So kalau you tengok, if you becoming what call it takaful agent or whatever, so basically you will be providing them, okay, sometimes we call it the takaful life. Okay, takaful life. So basically whenever you die, okay, you will not be compensated, but your waris, okay, your waris, okay, will be compensated on your death. Okay, for insurance, we have the health insurance, okay, disability insurance, automobile insurance, home and rental insurance, and so liability insurance. Right, this is normal insurance that we have, okay, in the market. Okay, and then we have also cash reserve, okay, to meet emergency needs, include cash equivalent liquid investment, and also equal to 6-month living expenses recommended by experts. Okay, basically our financial plan, basically we will have this takaful and also cash reserve. So how many of you have 6-month living expenses and in savings? Okay, they call cash or emergency fund. Okay, this is very important. 6-month living expenses. For example, whenever it can be used when you are being retrenched, okay, or you are being terminated from your job. So you have about 6 months for you to survive, okay, in the future while you want to get another job. Now let's look at the investor life cycle. Okay, we have accumulation phase, consolidation phase, and also spending gifting phase. Okay, so accumulation phase basically early to middle years, and consolidation phase past midpoint of careers. Okay, earning greater than expenses. Then you have spending gifting phase begin after retirement, right? So this is example of the individual investor life cycle. Okay, from this is age, okay, 25 until 75. Okay, when you start working, okay, your net worth, okay, your net worth, which means that asset minus liability, okay, it can becoming higher and higher. Okay, your net worth is higher when you finish, okay, when you want working, okay, you retire here, then you start your net worth becoming low again, right? Okay, so for example, now your net worth might be here, okay, but here is positive. But if your net worth is negative, which means your liability is higher than asset, then it will be down below zero lah. Okay, below zero. Normal people will have like this lah. Okay, asset a bit greater than the liability, right? We don't want to have a negative net worth. Okay, so this is accumulation phase. Okay, accumulation phase, basically your debts will be is for short term for house, okay, and car. Okay, for long term you want to save for your retirement, for your children college. Okay, this is for your accumulation phase. Then you have consolidation phase. Okay, you have you still have your long term, okay, retirement, okay, and then you have short term you want to for vacation, and then for your children college. Then you have the spending phase or gifting phase. So basically we have looked at estate planning. Ini wasiat ke apa ke. Okay, this is estate planning. Then you have short-term lifestyle and also need gifts. Okay, you want to spend money for your not your children, but normally for your grandchildren. Okay, for your grandchildren. Okay, untuk cucu-cucu selalunya you spend money for them. Okay, spend money for them. Okay, life cycle investment goals. So basically we have near-term high priority goals. Then we have also long-term high priority goals. Okay, then we have lower priority goals. Okay, so this is actually the life cycle investment goals. Okay, you have investment goal, near-term high priority, long-term high priority, and lower priority goals. Okay, lower priority goals. Okay, and then we have look at the policy statement. Focus is actually investors' short-term and long-term needs, familiarity with capital market history, and also expectation, right? And number 2, okay, examine current and project financial, economic, political, and social condition. Focus on short-term and also intermediate-term expected condition to use in constructing a specific portfolio. And then 3, implement the plan by constructing the portfolio. And the focus is actually to meet investors' needs at a minimum risk level. Okay, and number 4, to feedback loop. Okay, monitor and update investor needs, environmental condition, and also portfolio performance. So these are the 4 portfolio management process. Okay, first you need to have a policy statement. Okay, then examine the current and also the project financial, economic, political, and social condition. Then implement. Then you feedback. Okay, feedback, you do the performance management and also monitoring. Okay, let's look at a policy statement. Policy statement basically specifies investment goals and also acceptable risk level, should be reviewed periodically, and also guides all investment decisions. Okay, and then number 2, to study the current financial and economic condition and forecast future trends. This is also you want to look at the strategies. Okay, determine the strategies to meet the goal. Okay, require monitoring and also updating. Right, so this is number 2. Number 3 is to implement. Okay, so when you want to implement, you have to construct the portfolio. Okay, allocate available funds to minimize investor risk and also meet investment goals. Okay, and then number 4, to monitor and update. Right, evaluate portfolio performance. Okay, monitor investors' needs and market condition, and then revise policy statement as needed. Then modify investment strategy accordingly. Right, so sometimes you need to change. Okay, you need to change your portfolio, the assets in your portfolio. Okay, sebab tu you dengar cut loss. So basically you try to minimum the losses. Okay, if the asset is not performing well. Right, the need for a policy statement. So why we need a policy statement? Help investor understand their own needs, objectives, and investment constraint. Then set standard for evaluating portfolio performance and reduce the possibility of inappropriate behavior on the part of the portfolio management. Okay, portfolio manager. Constructing a portfolio statement, questions to be answered. What are the real risks of an adverse financial outcome, especially in the short run? Okay, what probable emotional reactions will I have to an adverse financial outcome? Okay, how knowledgeable am I about investment and also the financial market? So these are the questions need to be answered. Okay, this one is very important. Number 2, emotional reaction. What happens if your investment is not going as in accordance to what you plan? Okay, what other capital or income sources do I have? How important is this particular portfolio to my overall financial position? All right. And what if any legal restriction may affect my investment needs? And what if any unanticipated consequences of interim fluctuations in portfolio value might affect my investment policy? Right? Okay. Investment objective, you look at your risk tolerance. Okay, whether you are high risk or low risk or medium risk. Okay, tolerance. Okay, and absolute or relative percentage return. Okay, general goals. Okay, these are all the investment objective. So if you are low risk, then probably you will have your investment in fixed income securities rather than the stock market. Okay, right. So this is very important. So your investment objective must be important. Okay, general goals. Okay, look at the capital preservation, minimize risk of real loss. Okay, capital preservation is very important. Okay, or you want to go for capital appreciation, growth of portfolio in real term to meet future need, or you want to get current income, focus in generating income rather than capital gains. Okay, this is general goal. So it's either capital preservation, capital appreciation, or current income. Okay. And then also you look at the total return, okay, increasing portfolio value by capital gains and by reinvesting current income, or maintain moderate risk exposure. Okay, and then let's look at the investment constraint. What are your liquidity needs? Okay, vary between investors depending upon age, employment, tax status, etc. For example, liquidity needs for you. For example, you are now 21 years old. You might want to get married, right? So probably you need to have the money that you invest to use as the wedding expenses. So your liquidity needs differ from the one who have already married and already been working. Okay, so liquidity needs different between investors, age, okay, employment, tax status, and so on. The time horizon, okay, influence liquidity needs and risk tolerance is also different. Okay, so basically if you are looking at, for example, time horizon of 20 years, a time horizon of 5 years or 1 year, so it depends, okay, on your liquidity needs and also your risk tolerance. Tax concern, capital gain or losses tax differently from income. Okay, this is also the current issue whereby nowadays, okay, we'll call it the parliament. Okay, the parliament or Syed Saddiq is actually asking for the capital gain to be taxed. Okay, capital gains to be taxed. So untung saham kena cukai. Buat masa ni tak. Unrealized capital gain reflect price appreciation of currently held assets that have not yet been sold. Okay, dia ada dua. One is realized, this is capital gain, realized capital gain. The other one is unrealized, which means that you still hold the stock, you haven't sold it. Okay, you haven't sold it. We call it unrealized capital gain. So that is actually different from capital gain. Realized capital gain when the asset has been sold at a profit. Okay, and the trade-off between taxes and also the diversification, tax consequences of selling companies for stock. Iman, can you take the kat bawah dalam cat ais ada dia punya air bukan air semalam. Alright, sorry. Okay, and then interest on municipal bond exempted from federal income tax and also the state of issue. Okay, this is in the case of US. Okay, municipal bond exempted from federal income tax. Interest on federal securities exempted from state income tax. Okay, the same thing. This is also in US. Okay, also US. Okay, equivalent taxable yield. Okay, ETY. Okay, equal to municipal yield divided by 1 minus marginal tax rate. Okay. Now this is the effect of tax deferral on investor wealth over time. Okay. Now when you defer, okay, for example, here is its investment value. Okay, the 1,000 that you keep, okay, today until 30 years time. Okay, so you can see that the tax deferred, okay, is actually increasing from year to year. Okay, it's increasing from year to year. Okay, that is actually the 5.76 is actually after tax return. Okay, after tax return. Okay, so after tax returns ni which mean that you have minus tax lah. You have minus So that's why when we want when the government want to implement capital gain tax, basically your return will be lesser lah. Your return will be lesser. Okay, the yellow line ni. Okay, this one is the tax deferred. Okay, tax deferred, right? Okay, ini we don't have to look at this because this is US. Okay, this is also US, but this one is okay. Investment law prohibit insider trading. Okay, insider trading. So insider trading is not permitted. Okay, so if you become a portfolio fund manager, okay, don't do insider trading. Okay, this is will make you end up you in jail, end up you in prison. Okay, don't do insider trading, which means that you trade with prior information. Okay, you trade with knowledge of the company before the public. So this is what we call insider trading. Okay, unique needs and preference. Okay, personal preference as socially conscious investment could influence investment choice. For example, your preference is Shara compliance stocks only. Okay, so this is a personal preference. Time constraint or lack of expertise for managing portfolio may require professional management, and large investment in employer stock may require consideration of diversification needs and institutional investors needs. Okay, this is a unique needs and preference. Okay, so we have this is what we call it objective. Okay, the risk and return, constraint, liquidity, time horizon, tax factor, legal and regulatory constraint, and also unique needs and preference. And developing a plan depends on understanding the relationship between risk and return, and also the importance of diversification. Now let's look at the importance of asset allocation. So an investment strategy is based on 4 decisions, right? What are asset classes to consider for investment? What normal or policy weight to assign to each eligible classes? And also determining the allowable allocation ranges based on policy weights. Okay. And what specific securities to purchase for the portfolio. So these are the how we want to allocate our assets. Okay. How we want to allocate our assets. Okay. And then according to research study, most, okay, 85 to 95% of the overall investment return is due to the first 2 decisions, not the selection of individual investment. These first 2 decisions. Okay, what asset classes to consider and what normal or policy weight to assign to each eligible class. Okay. Okay, return and risk of different asset classes. Historically, small company stocks have generated the highest return, but the volatility of return have been the highest too. Okay, small companies, for example, companies in the stock market, if you look at the main market and also the ACE market, the ACE market is small company, right? They can give you high return, okay, but also the price also fluctuate very high. Okay, ACE and also the main market. Inflation and taxes have also major impact on return. Okay, return on treasury bills have barely kept pace with inflation. So basically, if you look at treasury bills, okay, in Malaysia we call it treasury bills also. Okay, for example, MGS, Malaysian Government Securities, and so on. So their return is actually at par with inflation rate. So for example, the return is 2%, inflation is also 2%. So there's no point of you keeping your investment in treasury bill if you cannot pace with the inflation. Okay, measuring risk by probability of not meeting your investment return objective indicate risk of equities is small, that of T-bill is large because of their differences in expected return. So focusing only on return variability as a measure of risk, no reinvestment risk. Okay, reinvestment risk is where you look at your what we call it, your return. Okay, then you invest it again back to the securities, right? So basically, we are ignoring the reinvestment risk if we are looking only on treasury bills return. Okay, look at the policy statement. determine the type of asset allocation depending asset allocation determine portfolio return more than stock selection. Over long time period, sizable allocation to equity will improve result. So basically, the theory says that when you have a bigger size in equity, your return will be better. Okay, your return will be better, and risk of a strategy depends on the investor's goal and time horizon. Okay, look at also this one. Okay, never mind. We don't have to this look, but we can see that differences, social, political, and tax environment influence the asset allocation decision. Okay, equity allocation of U.S. pension fund average about 58%. 58%. So basically, 58% in equity, and then another 42% maybe in fixed income. Okay, in the United Kingdom, equities make up of 78% of asset. In Germany, equity allocation averages of 8% only, and the rest will be fixed income. Okay. In Japan, equities are 37% of assets. Okay. So summary. So we have identified investment needs, risk tolerance, okay, and familiarity with capital market, and then identify objective and also constraint, enhance investment plans, okay, by accurate formulation of policy statement, and focus on asset allocation as it determines long-term return and risk. Okay, that's the internet or investment online you can look at here. Okay, so we end that for chapter 2. For chapter 3, we look at investment choices, okay, and then also including global asset and asset allocation decision. All right. So